Okay, 12631. This is Chess and Wine. It is Sunday, November 14th, 2010. I wanted to do the first part of a strategy session, to borrow a phrase from the CNBC show here, coming into this week. So I think it's really important that we have the correct frame of mind, like I said, coming into this week as far as a broad market. And what we can see here, and this is my daily chart of the S&P 500, is ever since literally the first day in September, we've got a bona fide uptrend here, a nice pattern of higher highs and higher lows. We've seen thrusts higher, followed by periods of consolidation, followed by another thrust higher, followed by another period of consolidation, followed by that big breakout to 52-week highs on a nice uptick in buying volume, as you can see at the bottom of my screen here, to fresh 52-week highs, followed by all of last week, where we basically filled the gap, had a fairly orderly pullback here. Selling volume never really got out of control, especially when compared to the buying volume of the previous week. And here we are, we've precisely touched the rising 20-day moving average, again, precisely touching it for the first time since really the uptrend began. So I think this is all healthy. This is all to be expected. Again, I think it's unrealistic to expect to see a market in an uptrend that never so much as comes in and touches at least the 20-day moving average. What's important for us as swing traders to understand is that we've got a rising 20-day moving average. We've got a rising 50-day moving average here, this blue line. And even the 100-day moving average, this white-gray line down here, is torquing up. And some of the longer-term moving averages, like the 150-day and 200-day, they've been flattening out all summer, and they look like they could be on the verge of torquing up here too. So I think this is all very constructive for us as swing traders. However, we do want to make sure that we're properly trading around the short-term swings. For example, let's say we had aggressively bought last Friday when the market printed 1227 on the S&P. Well, guess what? Ever since then, we've come down to 1194. That's roughly a 2.7% correction, and odds are your positions would be pretty underwater at that, based if you had bought there aggressively. So it is important to be cognizant of the short-term swings in the market. So therefore, going into this week, the issue is this the much overdue correction that everyone's been expecting or calling for? And we've already got 2.7% out of the way. If we come down another 2.7%, it'll probably take us to roughly this rising 50-day moving average. And obviously, it goes without saying, the moving average is a moving target. Last week, for example, the 50-day moving average went from 1150 and it finished the week at 1161. And this week, I'd expect it to go up into roughly 1170, 1172, that area. So it's going to be, again, rising throughout this week. So if we see a further shakeout here, I think this would be an excellent opportunity to buy. I know it's going to be tough if that happens, because I know, anytime you see a market sell off, necessarily almost, there's going to be a story that comes along with it. There's going to be a huge fundamental case, whether it's Europe, Ireland, what have you, the California municipal bonds, whatever. There's always going to be some story in there that's going to scare the heck out of the retail investor. But you really just want to try and block all that out. Unless we start to see a huge, massive uptick in selling volume accompanying another major thrust down, my position coming into this week is any further weakness should start to be bought. Now, you don't have to rush in and buy everything all at once. In fact, especially if you want to keep a cool head, what I would suggest coming into this week is you want to look for the very best setups. And again, the Raging Cajun and I are going to give you the best setups that we can see. It's okay to start to layer into these positions, maybe buy them a quarter at a time, a third at a time, layer into your positions on further weakness coming into this week, if indeed we see more weakness. Now, I'm expecting roughly, if we see more weakness this week, then I'd expect to see roughly the market complete a 5% correction roughly from peak to trough. So again, 1227, we got 2.7% out of the way. And I really would expect this 50-day moving average to hold firmly the first time we touch it, if indeed we touch it. Now, another scenario that I want to cover in the next video is that we simply continue to go sideways, or we could resume higher. So I'll cover that in the next video.